Today, the start of the interest rate wars. Hello again, it's Martin North from Digital Finance Analytics, one of the latest posts covering finance and prop news with a distinctively Australian flavour. Today I'm joined by Steve from Canstar. Hi, Steve.
Hi, Martin.
Great time to catch up. The RBA is going to probably move rates next Tuesday, and lots of movements in the markets. The rates wars are really hotting up.
Yeah, they are. We've seen existing borrowers all getting hit by an extra 0.25%, basically. We've got 95 lenders on our website. 4 of them haven't increased rates yet. One has said they're going to, the other 5 have. One said they're going to, the other one is, the other 4 have said, well, nothing yet, but they will. And the average increase is 0.25%. So the RBA increase 0.25, and the banks virtually all passed it on. Now, what a couple of them have done, though, and I thought this would happen, is that they've got these specials.
Yep.
And for new borrowers, they're giving a special discount and what have you, and cutting about 15 to 20 basis points off the amount that existing borrowers are going to be paying. So that's the way I think we'll see some competition for a little bit of time now. However, don't expect rates to start falling, because if the RBA goes up by 0.4%, which I think is the likely increase, you'll find that all of those specials will also start moving up at the same time.
Yeah, and those specials, of course, are all variable rates in any case, right? So essentially, you might be starting slightly lower, but if the rate goes up, the rate still goes up.
Yeah, the rate goes up, but Westpac's one of the ones that did this, and what Westpac has done is they've said, look, this is the discount that will apply from the reference rate for the first 2 years, and so you will always have that benefit of it being a lower rate than the rate that existing borrowers are paying. So you'll see that, but of course the rate will go up. I mean, if the RBA does add 0.4%, there won't be a lender around that can't. They can hold out and not put a rate increase through.
Absolutely. And I'm with you. I think 0.4% is probably the most likely outcome. 2 reasons. One is I think they want to demonstrate that they're serious about lifting rates higher. They are somewhat behind the 8 ball compared with, for example, New Zealand, who put 0.5% on the rates just last week. And, of course, the Fed's expected to lift rates when they meet later in June. So rates are definitely on the way up. And, of course, mortgage holders, well, they'll be paying more.
They will. I think the only reason it wasn't 0.4 last time is that the election was on, and I think they felt, well, look, we've got to put rates up. We're not going to be so political that we won't do that, but let's not kind of make it too in the face of people. Let's keep it to the 0.25 that everyone's used to. But the other reason is that for 0.4 now is that the Reserve Bank does like a nice, tidy 0.25 or 0.5 increase. And I think the market does too. They get used to processing it, and everything's a whole lot easier. So it just tidies it up and gets it behind them, so that we'll now be talking about 0.25 and 0.5, and there won't be any other real option unless something weird happens in the world markets. But the issue is, of course, that there will be another hit to repayments, and this is going to hurt people quite a bit. A 0.4 increase will add another $97 to a $500,000 loan, and that's on top of the $52 that went on with the last increase. So you're talking about $150 added to the monthly loan repayment already, right at the beginning of this increase in the change in the cycle to an increasing interest rate scenario. So that's kind of like a bit of an eye-opener for people, and sort of a real warning that says, look, geez, start your planning now. Don't wait until you see the full hit, because the full hit of, say, a 2.5% increase that the Reserve Bank governor said wasn't unreasonable, is actually on a $500,000 loan putting you up $680 on what you'd have been paying in April just gone. So it lifts your payment from $2,103 to $2,783. That's a huge increase out of a household budget.
Yeah, and of course, if you have $1 million mortgage, as some people do, The quantum's huge. And, I sometimes remind people that, a 1% increase in the interest rate is around a 15% increase in the repayment that you have to pay on an interest and principal loan.
Yeah, it's the way the numbers work. There's a rule of thumb called the rule of 72, and the maths is beyond me, frankly, but I used to know it. But yeah, the amount of interest in your repayments goes up, and so it's not a nice linear. The rate goes up by this, and your repayment goes up by this. It escalates. So you're up for a lot more, and your $1 million loan will double that number, double the $680 to $1,360. Yeah. That's a lot of money.
And then we should also overlay the other costs of living, of course, because we know that power and gas prices are higher. We know that food prices are higher. The inflation rate's above 5%, and for non-discretionary items, it's above 6%. And so households are really going to feel the pinch here on multiple fronts. And, rates are going to go higher probably down the track too. As you said, the RBA is talking at least 2% higher from where they currently are. So we are in a whole new world of pain when it comes to household budgets, it seems to me.
Oh, yeah. And there is the both governments, potential governments, now it's decided, we're highly reliant on wage increases coming through, but not very specific on how they kind of see that happen. The Reserve Bank governor has faith that it will happen because he says, well, look, we're at full employment and wages will be bid up. Well, we're seeing them bid up in some sectors, but not others. We're seeing shortages almost everywhere, but wages aren't going up in every sector. And sure, if you're in the tech world or the digital world, you'll see your wages going up, but not everyone is, and it's really lagging behind. And the things that are going up, electricity. I don't think you mentioned this. You probably did, but the cost of power is really scaring people at the moment. We're seeing just a mushrooming of our visitorship, our visitors to our Canstar Blue power side, electricity side. People are very, very worried about power, and we've got a pretty cold start to winter. So yeah, meeting the cost of living with interest rates on top is going to be a real challenge for a lot of households.
Absolutely, and it's interesting that some of the smaller energy companies basically are now encouraging people to switch away to some of the bigger ones because they can't compete.
Yeah, that says everything, doesn't it? For a business to actually say, leave us, because we can't make money out of this. We're going to have to hit you with a ridiculous increase to be able to retain you as a customer. So you better go. I've never seen anyone do that before, and it just shows how serious this problem is.
Yes, and it's definitely embedded. Now, one of the other interesting observations is that the banks have also now started to tighten their underwriting standards. And, of course, not only will they effectively still be applying the 3% above the rate calculation, but they've also now changed some of the debt-to-income ratios that they're actually prepared to lend at, which I think is quite significant as well.
It is because, all right, it won't affect every person in the market, but there'll be a lot of people who will be cut out from borrowing the amount that they would have borrowed before. They'll be borrowing, sort of $50,000 less or something, which means a house worth $50,000 less too. Now, houses have been overpriced, and if they fall 10 to 15%, that might not cause that much drama to people, but then they've got to wait that bit longer to see if that does actually occur. But yeah, that it's a rule of thumb that sort of 6 times, 7 times, 8 times, and one of the big 4 banks cut it during the past week, and but they were at a pretty generous level.
Yep.
Now the banks don't just rely upon that rule of thumb. That's sort of a bit of a knockout rule. They still do your household budget and say, look, what income is coming in, what expenses are going out, which ones are discretionary that you will or can potentially cut out, but which ones do you have no choice but to pay. And they'll use that as the prime measure. So you've got to be able to establish with the bank that you can afford the loan. And this 6, 7, 8, whatever the multiple debt to the income you've got is just that rule of thumb that says most people on average can afford this much of a loan.
And of course, it's a lot higher than it used to be. I can remember when I used to write loans years and years ago, it used to be 2 times the first income and plus 1 of the second income, right? And that was about it, right? Those days are gone.
And Martin, you would ask questions that you could not possibly ask now.
Absolutely.
So I mean, yes. People talk about the good old days, but they weren't that good. Getting a loan from the bank, and I was in the same situation, but in a different bank. Getting a loan from the bank, oh, gee, you had to have a family history that dated back 3 generations, and you'd have been saving with the bank, with $50 going in every month for the last 5 years, and you'd have to we'd shade the amount of the borrowing against the loan by 20%, and then we'd only lend 2/3 of that, and we'd give a top-up personal loan, and it was a nightmare. So people think it might be tough these days, but it was no picnic. It was a much more difficult exercise applying for a loan then. Terrifying, actually.
Yeah, it was terrifying. Absolutely. I always remember people sort of imagining the bank manager sitting on a very high seat, looking down across the table and saying, "Well, can you afford it?"
Absolutely. Push the glasses down the nose and peer over the top of them, and with huge scepticism.
Yeah, exactly right. And of course, the consequence of that was that home prices weren't able to rise because effectively you couldn't get the credit to drive it. So one of the reasons why home prices have risen so fast and so hard is because credit has been such more freely available. So there is a very strong and direct link. And of course, that's a consequence of interest rates being cut very significantly, but also the lending standards being much looser than they were.
Yeah, that's right. I mean, we would never want to go back to those bad old days, good old days, whatever we're going to call them. But the fact is that we've had the ease of credit has absolutely fueled prices, and that's a two-edged sword. I mean, we all feel a little bit better when we've been sitting on our loans for our properties for the last 10, 15, 20 years. We feel pretty good about that because we've now got a lot of wealth. But it produces that have and have not issue where a whole bunch of people, not just young people, but a whole lot of people on middle to lower incomes are actually excluded from owning a house. And it's sort of like, the great Australian dream. Well, we're no longer one of the countries that has the highest level of home ownership. We'd be top quartile, but we're no longer right at the top of that tree. And it does produce social issues that, frankly, I don't think as a nation we've actually addressed them at all yet. We talk about social housing, and we might build a few more houses and things, but demand is going to be a lot higher in the scenario we're facing now for social housing and for other solutions to this housing problem.
Absolutely. And in fact, the ABS published some data quite recently just reconfirming what we already knew, that the proportion of households renting has gone up, the proportion of households with a mortgage has gone up, the proportion of households who actually own their property outright has gone dramatically down. And interestingly, a lot of people are still now going into retirement with a mortgage still in tow, which is not actually necessarily very comfortable.
No, and it frustrates the whole superannuation industry, the whole dream when universal superannuation came in, which was to get people to the point where at retirement they would be able to self-sustain and take the load off the taxpayer and future taxpayers of funding people in retirement. Now, we're nowhere near that. We just haven't, we've hardly scratched the surface towards that goal. Yep. For a number of reasons. I mean, one is the government starts taxing it, which was never the idea at the outset. So we're getting no closer there. And this scenario of people retiring still with a couple of $100,000 on a mortgage, effectively what they do is take the superannuation, pay out the mortgage, and then go and apply for a pension. And their lifestyle will diminish dramatically in retirement. But what do you do?
Yeah, well, it is the consequence of getting a mortgage later in life because the savings journey was much harder. So, the average first-time buyer is, mid-30s now rather than mid-20s, and that has a knock-on effect, doesn't it?
Oh, and the mortgages are so big, compared to the past. The mortgages are huge. So, $1 million mortgages are, well, they didn't exist going back 15 years ago, maybe 10, except for the mega wealthy. Nowadays, this is kind of the norm when people are entering the market.
Absolutely. No, it is a very different world. But there is some slight good news for those with savings, right? The green shoots of savings has started to appear as well.
They have, and that it is great news. And what we're going to see is more savings rates go up and a lot more pressure on banks to pay better rates on savings. And it's because, when you get into this sort of cycle of interest rates going up, the wholesale rates tend to go up a lot faster. So these are the rates that are borrowed from the big end of town, from superannuation funds and the like. And so they go up a lot faster. So retail deposits is what the banks call them, but they're the transaction accounts and the savings accounts that people have with the bank, become a lot more attractive to lenders. And so they'll start bidding those up. And in the last couple of cycles, the interest rates being paid to savers have gone up a good deal more than the actual Reserve Bank cash rate increases and more than the loan increases. So it is good news. It's the start of good news. Unfortunately, and this is not surprising at this early stage, only about half of the banks have actually increased savings rates.
Yep.
And there's term deposits and the savings accounts. So it's a little slower to start and take off, but it will happen, and it will happen a lot faster than I think the pessimists think. So it is good news. It's green shoots. You must look around though, because there are still some very ordinary rates out there in the market. The other thing about savings too is that look at the fine print in the account. I mean, your standard savings account these days has a base rate and a promotional rate, and the promotional rate runs off in 3, 4 or 5 months. Now, a lot of the increases that we've already seen, in the last month, have purely and simply been to the bonus rates or the promotional rates. So you've got to check them out. And bonus rates are a slightly different scenario, but if you can't qualify to get the bonus rate every month, to get the bonus every month because of your savings or some other conditions, and some aren't tricky, and some are more difficult, don't take out that account. Find one where you will qualify, because if you don't get the bonus, normally the base rate is a peanut.
And a rather small peanut at that, right? But you can, if you look around, some of the term, longer term deposit rates are now 3% and 4%.
Yeah. Now they have started to move up. But look, to get the sort of interest rates you're talking about there, you've got to be locking your money away for 2 years or 3 years or longer. Now, I'm not sure you want to go and do that right now with the Reserve Bank likely to add another 0.4 and some of those rates go up again. But for a year, you can still get 2.3%, which isn't too bad. It's pretty good rates, miles ahead of the average.
Yep.
So it's kind of, you might want to spread the terms a little bit around so that if the Reserve Bank moves really quite quickly, you won't have locked all of your money away. So spread it amongst a couple of terms here. But I'd kind of be nervous about locking money away for 2 or 3 years or longer at this stage in the cycle, because I think you'll do a lot better in 6 months' time. Yeah. But again, chase the better rates. There are some pretty reasonable rates, and there are some pretty low and terrible rates. So make sure you get a good rate.
And I think you make an excellent point, because, at first blush, a 3 or 4% rate looks pretty good, and certainly better than what we've seen, for some time. But we are in a very different trajectory now. Rates will go higher. And what you don't want to do is lock yourself in for 4 or 5 years if, in fact, 6 months to 12 months' time, rates are going to be a lot better. So picking the rate and picking the term is actually quite tricky. That's why you need good tools. Canstar's tools are great because you can see all the different options and choices, in term and rates and things. But I guess it comes back to the fundamental point that we keep saying, and we have to say it even more loudly now. It is worth shopping around, whether you're talking about your mortgage rate, whether you're talking about deposit rates, whether you're talking about your power. As individuals, the best way to try and deal with all of these pressures is to know where your rates are and to know where you can move to the better rates and switch, because people just don't reward you for being with the same organisation for a long time. You have to take the initiative, and it's the best way to try and deal with some of these inflationary pressures.
Yeah, look, you do. Get with the stream. We've seen a lot of traffic, big increases in our traffic to home loans, as you'd expect. But also term deposits are starting to really boom traffic-wise on our website. So people are in there comparing. And the informed money is comparing. So if you kind of feel you're a bit inexperienced with this, that's the way to go. You've got to do it. The range in rates, the range for savings and for home loans is massive. So everyone is going to be hit with these Reserve Bank increases if you've got a home loan. But you can start your home loan around 2%, not the average of 3.2%. Now, get into one of those lower priced home loans now while you've got the chance, and then you'll only be adding the 0.25, the 0.4% increments to that lower base. And so you'll be putting off the real pain. But there's a second thing you should do if you can manage to get into one of those 2% loans, and that is get ahead with your repayments. Don't cut your repayments back. Keep them up there if you possibly can, because you'll be up for those sort of increases anyway. You might as well start them early, because when you start them early, you put them into a loan that has redraw, and you can actually pull it back and subsidise your future higher repayments. So they're the two things: get into a low base, but keep your repayments up so that you get ahead.
Yeah, absolutely. And it still amazes me that when I survey households, how few actually know what the current rates are that they're paying.
Yeah.
Step one, find out what you're paying. Step two, find out what you could be paying. Step three, make the move, make the switch. And the time and effort that you spend doing that will pay back handsomely, particularly now, in my view. But there is a little bit of it's all too hard. It doesn't have to be hard, does it?
No, it's not. And look, nothing focuses people on knowing their rate than seeing the rate go up and seeing their repayment go up. And that's what we're seeing right now. People are actually focusing on it much, much more. But, if you think back to, 11 years ago, GFC, where rates started tumbling first up. Before the GFC, the home loans were up around 8%. Now, I'm not saying they're going to get to 8% this time around. I hope not. But they can easily go up to 5 or 6%. So, that will start focusing people. But when the people paying a rate around, the average of 3%, with still a memory of 10 years ago when they were paying 8%, they think they're on a great deal. Well, they're not. Everything is relative, and there are better deals around. So, do compare. There's a lot better out there. Unless you've addressed this over the last year or two, there are much better deals out there than the one you're on.
And I think you make another important point, that things change, right? So even if you had a good deal then, it's worth checking to make sure that it's still a good deal now, because things have moved under you, and you might find that you've actually got better alternatives again. But again, it takes a bit of effort, but it's not hugely problematic to do, and the payback can be very significant.
Yeah, it can. Going back to pre-internet days, you'd have to go and walk the blocks, walk the high street, and get the brochures from the big four banks and a couple of other building societies or something to get a few rates, and then you kind of pick one that looked reasonable and one you thought you qualified for. But now you go online and you can see 96 lenders listed on Canstar site, for example, and compare thousands of home loans. So, it's so easy then to select. Applying is becoming easier all the time too. We've seen new digital offerings from one of the big banks just released in the last 2 weeks. And there are lots of other digital offerings where you can apply online. are brokers out there, and there are much easier processes than there used to be all around. So you've really got to get out there amongst it and check it all out, and then put in a bit of effort. And it's a bit of effort that's not that tricky anymore.
Exactly right. Last question before we sign off. House prices now look as though they're starting to slide, particularly in Sydney and Melbourne. I guess that's a consequence of higher interest rates, plus I think also consumer confidence. What's your take on what's happening, and how should we be thinking about it over the next few months?
Yeah. If I saw this level of change kind of 2 or 3 months ago, I just said, look, this is probably a blip and nothing more. But now that we've got interest rates here, people are saying, look, we know it's going to get higher again. And we've just got to bite the bullet and say, yeah, probably now is not a great time. Investors in March numbers, the ABS numbers are a month or so too stale, but anyway, they're good enough for what I'm going to say. Investor borrowing was up 46% year on year for March. Now, that will have slowed a bit already, and investors are not going to going out into the market now when there's an expectation of prices dropping. And most people are saying somewhere between 10 and 15% drop in prices. Now, I think, frankly, we had to have this, that sort of drop, because we've just had such crazy escalation in price over the last couple of years that it has meant people not in the market are just going to find it really hard to get in. But it must be super scary for someone who bought within the last 12 months because they'll be saying, gee, I made a bit of money there at the beginning. I'm going to wipe most of that out pretty quickly. And if you've only bought in the last 6 months, well, it's even scarier. So we'll see people going into negative equity because they borrowed on very skinny deposits with either one of the government schemes or lenders' mortgage insurance, and they're going to find it pretty tough actually when they look at it and say, well, look, I've got to pay these ever increasing repayments, and my equity is quickly diminishing every month. I look at another few percent being knocked off house prices. So psychologically, it's tough. But what I do encourage people to think is longer term, and provided you can actually meet your repayments and you keep them going religiously on time every time, you will find in time that it corrects, and over 10 or 15 years you'll be way ahead anyway. So don't get too freaked out by words like negative equity or falling house prices, because it would be a first ever kind of scenario in Australia where after 15 years you weren't ahead.
Yeah, and of course the migration and population growth was always going to put a bit of a floor underneath the long-term trends. But of course people will be worrying about writing it up and writing it down. Interestingly, some of the banks are actually offering higher loan-to-value ratio loans than they were the other day. So I noticed that there are more 95% loans now available than previously, which is interesting time to do that.
Yeah, I guess they'd be taking the same view that I am, I guess. First up, they say you've got to have lender's mortgage insurance. So, you pay that as well. But they'd also be taking a longer term view and saying, well, look, it will take care of itself. We as a bank have to make sure that the people we're lending to can actually afford the repayments and the increasing repayments. So they're relying upon the income assessment to say, look, we'll lend at 95%. So let's hope they have it right and they're not taking any shortcuts, and that people are understanding that taking a bigger loan in a rising rate scenario has risk for them.
Yeah, well, Steve, thanks for your time today. And I think the bottom line message is households can still take the initiative. They can still get on the front foot with some of these rate changes. And if you're smart, use this as an opportunity rather than see it as a threat.
Yeah, absolutely. It's a reminder to get your house in order, to make sure that you've got a cheap loan and that you're making extra repayments, provided you can afford them at this stage. A lot of people can't. But if you can afford them, make extra repayments now, because it will be getting tougher. So, you can do things about it right now. If you don't start planning for it, though, it train coming down the rails towards you.
Absolutely. Steve, thanks for your time today. Really appreciate it. Great advice as always. And I'm sure we'll be chatting again just in a few weeks as things continue to develop.
I hope so.
Take care. Bye-bye.
Okay, see you, Martin. Cheers.